Hello to all our COL investors and participants today. And I'll be very quite happy to be able to give you our presentation with regards to the technical conditions of our market. If I could just borrow the screen share, please. May I just double check if you guys can see it? Okay.
Yep, we can see it.
Okay, so I feel quite a bit more established this time around than my talk with you last year because last year I entitled my report as 2023 as a bottoming out year. And it took a while to actually shape that bottom because it came quite late, especially after the initial rally that we saw in January, which I'd show in a little while. But let me just give you a quick summary of what I'm going to be talking about today. And in terms of the landscape of what we're trotting through, I think the Philippine technicals look much better than what it was a few months ago when things still look iffy, especially after the low that we generated in October. And it managed to be able to establish this higher low base. And I think the only problem we have right now is major resistance, which is standing in our way at 6,700. We'll show that unit chart in a jiffy, and I'll try to be able to discuss what the options will be. And hopefully, if we can break that 6.7, then we can go into our next target on the upside, being a range between 7,100 and 7,500. With regard to the US technicals, clearly we have a very strong market there. We're coming towards a January period where both the Philippines and the US did show some degree of volatility, so we're going to have to watch that quite well. And yes, it could do with a bit of a correction. Right now, I don't see the bear market potential coming in, but we'll see how it goes later, especially if those negative scenarios April was talking about do start to be able to show up, then we shall make a reassessment. But right now, they look quite strong to me. In terms of inflation, bond yields, and the prospects for interest rates, like she also said earlier on, I think we've hit the tail end of that rate hike cycle. And now we should be looking forward to rates coming back down. It's just a matter of when they're going to begin it and with how much. I take that to be quite positive and to be able to suggest looking towards a risk-on situation rather than a risk-off situation. But yes, like Avram pointed out, history could cause some volatility, and I guess we should just be ready being traders. That should be more of an opportunity for us. In terms of the dollar and peso, there's been some weakness in recent days into the peso's move against the dollar. I don't think this will last very, very long, but we may have to be able to deal with that just a little bit longer, especially if the dollar manages to rally a little bit more after correcting quite heavily. So I think this will look to be quite temporary, so not so much so lingering for a very long, long period of time. And of course, commodities have actually shown good signals in the sense that they've come down. Yes, there are a little bit of rallies, but I think they'd be subdued and very slight and maybe not so much of an upstretch yet, unless, of course, one of the risks that maybe April was talking about being the issues into the Red Sea that might harm supply problems, and then we'll look. But right now, I don't see those things coming in place. So let's quickly look at the Philippines. Last time I met you in July, we said that 2023 will be a bottoming out year. And at that time, we did come from a nice, strong January rally, which eventually just turned downwards, and it created a bottom in October. If you look at the index chart up here on the upper part of my screen, this was the model I was using to try to gauge what the Philippine market will copy. And at that time in July, this is what it looked like in the bottom. And I said at the time, and I drew this red line down here, and I said the market will come down and do 3 corrective cycles like this, like an ABC. I didn't know exactly what low it would hit, but I said something like this, and then come back and make a year-end rally. So let me show you what happened. So this is the current market. Here's that red line. I just drew it up for you. And as of that time I gave the outlook, the market did fall back down all the way down here, closer to about 5.9. And then it managed to make the year-end rally and still stay where it is today. and right now standing at an essential critical major resistance points, which is at 6,700. Why do I say it's major resistance? You can see a major downtrend line which started back in 2022 from the highs, and you can see that we have this little bit of a snag that we have to be able to break over in order for us to be able to open up more upside action. If this does not open up, then we're going to head into a corrective movement, and the market may need to be able to establish a higher low base in order to prepare for itself to attack this level of resistance once again. So let's go back into that index, but let's try to be able to examine the change of events. Why, of course, I said that 2023 will be a bottoming out year, and why I feel a little bit more confident now around. And you will see why on the technicals. There's something what we follow in technical analysis called a 3 trend line system, that if you see 3 downtrend lines, for example, break successively, then normally that usually leads into a major change in trend. So if you see the first one is this one here, this trend line was broken because of this rally, and then we had a correction. And then this time, the trend line over here broke, and number 2, and now we are on the 3rd. And so this is the last stage that we have to be able to push over in order for us to be able to confirm that indeed we do have a trend reversal in place, especially with this higher low also being established, which is also another signal we watch for in technical analysis to show you markets getting stronger. And so that's really it. There's only one more gate that seems to be blocking us. And if we do breach 6-7, then it's 7,100 to 7,500. That would be next into our target. Now, there could be 2 ways to be able to do this. So we're going to look at the situation that will produce prices pushing above the 6,700, like you see here. So currently, the index, what it could do is it could stop right this right now and go through a correction, or I hope we can break out just a little bit more first. At least that be the tip off, telling us that things are still improving, and then sink back into beneath it, but then generate a higher low, and then eventually rally back, and maybe seeing 2 corrective swings towards this particular 2024. Now, the opportunity that will present for a trader, I'll discuss later, because as you see higher lows, that could be good entry points for people who are buying, especially into the short to medium term, and that will present opportunity, especially for those people who are not able to buy in the last rally that we've seen. The negative scenario, I would say, is not so negative. It's only negative in so much as having to wait a little bit longer. And the reason I say that is because this red line that you see will be my bear case. So that means that in case that the market fails to punch or lingeringly past 6-7, it'll come back down, maybe all the way to about 6-3 or maybe even 6-1. Then they'll hold its shelf because there's a major uptrend line now that's holding this as support. And then eventually turn up and work its way back into that and eventually break through this upper barrier, but maybe later towards the end of the year, if not into the new year. So not so much looking at to go into a bearish situation. And the reason why I say bearish is because, in technical analysis, we have a way of measuring a bear market. A bear market will have to drop a market more than 20% from its high. So if you only get a partial move between, let's say, maybe up to 10% to maybe just over 20, that is considered a correction, not considered a bear market as yet. And I'm looking only at a pullback to maybe a correction for what we're going to be seeing this year. So where are we into the Elliott situation? Well, if you look at the Philippine situation, I'll just extend it from, yes? Did somebody ask me a question? Okay. So looking into the aspect on the Elliott's situation, we seem to be doing still quite well. Last time I met you, I said, I think we are in a truncated or a shortened 5th wave. So in Elliott, if you see a corrective movement in a bear market, usually you get 5 waves down, 1, 2, 3, 4, 5. After that, finish itself off. Normally, the 5th wave should even exceed this lower one, but this time it didn't. So that's your first good signal. Next is this last low we made is even higher than the last one, which is your second good signal. And like I said earlier, all we have to do is punch up through one more, and that should give me 3 good signals, and that should be getting us ready to go. This is just a shorter term version of that picture. So this is that 6-7 marker that we're trying to be able to work off. So all we really need to see is this market just pull back, wind up somewhere in this area here, and prepare itself for a potential punch out of resistance, and that should clear the path towards our next new high targets. Now, also last year I showed you this particular image, and I just wanted to continue it because last time I met you, I said we were in a bearish to a market bottom phase, but now I'm changing it. I'm moving it forward a bit. So now we are in the market bottom, and now we're turning up the rounding off from this area. And again, like I pointed out, after we've made major bottoms like this, it always led to the market eventually going back to a new high. So that puts in a lot of hope for us that since we've seen the worst, and I think even interest rate cycles are telling us that the high interest rate cycle is pretty much done. We just have to wait for it to gradually ease. That should tell us that that should be able to paint us a much more rosier picture down the road. So I keep quite optimistic about that. Now, with regard to the United States, this is a little bit different because this market has been quite explosive and red hot. Yes, there were a lot of tech issues that were doing quite well and what carried the market and is still carrying the market today. But last time we looked at the market, we said that it was quite buoyant, but it was overbought. And we said that the S&P had to be able to move into a correction or consolidation. And at that time, this was the scenario I was looking for. If you can see the dotted line here in the bottom. And on top of this, this was the model I was using to gauge what the US market would look like roughly into the medium term. And you can see this model I used in 2004. It showed that the market would do a consolidation just like this. At that time, remember, we were over here, and this is what we were looking at. And I wanted to show you what the US market actually did. So if you look below, this is what happened in the US market. So a little bit weaker than the actual drawing that I made, but the swing cycle followed it almost exactly. You can see how closely resembled it did to the one on top. And then after that, the market jumped up here, and so did it, also climb up quite forcefully. And I drew a red arrow just to be able to designate where I think the US market is in the face of things. So if you were to look at it, it will also tell you that in a short period of time, there's going to be this corrective movement that could come in, maybe interrupt it for a few months, but maybe not to be able to drive it so much lower, right? Because the scenario that April was talking about, that if they do go into a bear market, and like I said earlier, bear market means it has to fall 20% or more from the top. So if you were to calculate where it is today at 4.9 and drop 20%, that would drop it down to 3,900. That would be all the way down here. Okay, so I'm not looking that far down, although yes, I have to be able to admit I have to expect a correction because I don't think you can linger a market up this way too long. And in fact, there could be maybe 2 corrective motions that could come in this year for the US. So this is what I'm anticipating for the US. Maybe again, 2 corrective motions, but within the uptrend, maybe not go all the way to 3.9. But again, we're quite looking at this area here. So if we do get a break with regards to the aspect of this trend line, then obviously that will be a risk to my particular type of scenario. So for now, I think we'll get to some corrective motions, but still maintain the advance that the US is doing. April shared some of these slides already. I'll just relatively go through it. I just wanted to be able to assess the level of risk we have with regard to some of the headwinds we've earlier seen. This is inflation in the US. So far, it had picked up a little bit in the last couple of months, or especially in the last month, but I wouldn't expect inflation to jump back to where it's come from. I think what it'll do is it'll just probably go up and down. There are still some troubles that it's encountering, so maybe not see the 2% marker that the Fed wants to see, and that could be the reason why they may delay the rate cuts and may not be too aggressive in cutting also at the same time. In the Philippines, well, I think we've seen that inflation has been quite low, so I don't see inflation too much as a threat. 3.9%, we've been with that rate like that for quite a while, if not higher. So I don't think this will be too much of a problem. So at worst, I think what we'll see, there could be a little bit of a rebound in inflation, but only for a sideways type of inflation, not something that will go back to 5 or 6 or 7%. I think those days are over, unless, of course, greater war takes place between countries, and I guess that's the only risk that could toss everything we've said down the drain. In terms of bond yields, also, we've seen it way much lower than when it's come. I think the rally you're seeing today will probably just be more of a sideways type of band rather than a continuing recovery. So I don't expect this to play out as negative factors into our market. If you're to look at the 10-year Philippine bond, the same condition, maybe feel some resistance, maybe closer to about 636, 633%, and maybe not go too much more than where that area is, and then drop itself back down into a consolidating range. So not much threat with those. Also, I just look at key commodities. This is wheat on top, oil beneath it, coal here in the bottom, and nickel here up on the upper right-hand side. And I think you can kind of see that although there were some rallies in oil and maybe a little bit in wheat, it's really not too very large for me to get too concerned about. And most of these items here are still very much looking to either sideways or a decline in terms of its trend. So I don't see too much of these things showing as a threat to be able to gear inflation up again. So that should keep itself in a good news for us. And then also I want to be able to talk a little bit about the dollar and, of course, the peso dollar. Because in recent days, we did see quite a bit of some weakness into the peso dollar. But I think this looks to be quite temporary, although we do have a major up channel still grooming inside here. This is because the bigger picture shows a major decline, then a bit of a big rally in this channel. Maybe one day this will probably turn back down, but for the short term, maybe just finish off its rally. I'm thinking maybe between 56.70 to maybe 57, which is this area up here, and maybe that be the high end of it, and then probably correct itself back down now. The dollar, I think, will be also limited. Maybe 104.25 will be a resistance, if not 105 as a maximum. So not really looking too much out there just yet. So I don't see this as a potential threat for us as well. And looking to Asian markets, I think April did talk a little bit about China and how that could be a potential recovery factor if they resurge. But right now, of the three weakest markets in Asia, that's Thailand, Hong Kong, and Shanghai. Right now, the rallies they've had in the last few days because of the potential talk of the Chinese government putting in some incentive or stimulus, that generated quite a bit of a rally into their markets, but the downtrends have not been broken. And so the only markets I feel quite good about in Asia are still a good number of them. You have the Japan, India, Malaysia, Taiwan, even Indonesia, Australia, Korea were okay. Unfortunately, the Philippines and Singapore were kind of in the middle to the lower half of where we stand in terms of its placement. And that could be the contributing factor why volume levels in our country and in our local bourse have not really improved by leaps and bounds just yet. So I think Serge asked what could eventually put some positive aspect of that. Well, I think it may not be steered by us. It might be steered by the other countries rallying and becoming a bit more pricey. And then eventually people are saying, oh, we eventually will have to play a catch-up game, and maybe there you'll probably see some rotation. But one thing better is we're clearly not the weakest markets, and at least that's something to go on, because that means that at the least there is some coming back inside here, but we're not on the prime candidate for that. So it might take a little bit of time for that volume to come back in any meaningful way. And that's why, of course, there might be some degree of reservedness in terms of our ability to tone down aggression. So in terms of the summary of what I talked about so far, so we're okay. The only thing we need to is one more obstacle at 6.7. And if we can clear that particular resistance point, I think you'll probably see a bit more viable movements into the market. Both the Philippines and the US are a bit stretched and could do with some corrections, so you will have to be able to prepare for that. And we should take this as an opportunity for us, because these windows will appear once or twice this year that will allow us to be able to jump back into the market and and have a little bit of more upside rather than where we are today, which is not exactly very big if you're looking at where we are compared to a 7.1 or 7.5 target. Now, the risk points out there, I think, would be one, if they don't cut rates to on time. Like I think what people are playing around with is a May type of rate cut. So let's say they delay that for 1 quarter or maybe even two, then that might be a surprise to the market that they might not take too well, right? So that's something to be able to be watchful of. The second, the problems in U.S. elections, because they do have one coming in October, November, and there's a name coming back up into the picture that might change the whole course of how things are moving. So that clearly may pose some degree of risk. And of course, the other one is the escalation of the supply problems being caused by the conflict zones we currently have, not just in the Red Sea, but in Ukraine and any other place that might join the fray in any of this. And that could be a potential risk factor for us. But my advice to you is to be able to keep your eye on the recovery ball, because I think this is where we're headed. We've seen the worst. We've seen a higher low into the market that paints us a very good picture already, and that there are clearly some strong trending issues that are positioning ourselves into the market. And you have to learn how to be able to prepare yourself to take advantage of these things, especially when corrections appear. So, last time I met you, I told you that I think the way we should attack this market is we should be a bit more of a hunter-gatherer, are the words I use. And that means, you go out there, you're not just going to attack anything that moves. You have to be patient. You have to be watchful. If you see an opportunity, especially if you get a major sell-off, then you take it. Then you're going to have to be prepared to hold it, right? Because that's the way the market is. It's not about to run away. This time, let's make that just a little bit more aggressive, but not overly aggressive. So you have to still be a market timer, but you have to pick strong issues because that's where the volume is going. And if the volume is going there, the movers will be there first. And so start to be able to look for the leaders. They're the ones that are trading above your 20, 50, or 100-day moving EMAs, and especially those that are taking good volume flows. Start with those issues first because they're probably going to move more, especially after a correction. So, and don't get scared if a correction comes. We're talking about it here to prepare your mind, okay? Not for you to get scared, but for you to be prepared that once they come and they finish, that's an opportunity for you to be able to buy back the markets. Corrections are going to be obviously a trader's favorite tool because it provides you the new opening to be able to do that, especially that we're coming from resistance right now. So if somehow the market can back off, and I'm estimating support is closer to about 6.4, 6.3, and if we can just stay in somewhere there, maybe to a maximum of 6.1 and rally from there, I think that's the opportunity we're looking of. So if you see momentum start to slant downwards already now, then you might have to take some of your profits from your positions. But my advice is please don't sell everything. Since we're already in a turnaround situation, you want to have your core position intact. Maybe half your position or 3/4 of your position, you can take your profit and then use that as your cash buffer to buy back into cheaper prices. Now, can I just hold my position? I'd say yes, you can. And that's why I say the long trade can still show more promise now, because since we've seen the bottom, then our risk of going back lower is no longer there. So you can hold the position. It's just that because there are a lot of things that you have to anticipate and some challenges that we could still face, you might have to bear with the volatility. So just prepare yourself with that. Now, the other question you might ask is, what about laggards? Should I be buying laggards out there, the stocks that have not moved yet? In my trading career, I normally will only go there after I see frothiness from the prime movers. So once the first round of movers become too pricey or they get tired and people have made their money there, that's the only time they take profits. Then they look at the second or third liners and they put their money there. And that's the rotation you will have to see. So unless that condition happens and you see all your prime movers start to bank off, I think it might be hard for the laggards to move on their own right. It might have to be able to go through that rotating process, especially since I pointed out to you that since the Philippines is not on the top of the list of everybody in Asia, we need to make sure that volume will come in our direction. So take your time with the laggards. You can buy a little bit. Don't be too aggressive. It might take some time for them to move, but I think eventually they'll get there. But stay first with the prime movers. That's my primary message for you first for today. So for those that are strong in terms of their trends, those issues that are trading over their 100-day EMAs, and just pull back to your 20 or 50-day or 100 days. These are your openings. So your MACD will show some weakness. Let the stock come back down. Let them stabilize and make higher lows. And these are your opportunities to buy into it. But for now, I think you should be top slicing some of these issues so that you can take advantage of the pricing and prepare some cash for buybacks later on. Now, the nice thing about this is breakouts from this market can now continue. Breakouts from the previous market would be duds, or you get a lot of false breakouts because there's no momentum in the market. Here, I've been seeing a lot more continuity. Some issues have been climbing, the likes of Jollibee, GT Cap. Some banks are starting to move. You're getting much more leeway now than you had in the last one. So these are all, of course, clearly positive signals. Now, as for those who are going to go into laggards, obviously I can't stop you, but I would say that you have to be a bit more patient. Try to allow them to climb above their 50, 20-day moving averages first. If they're still below those two moving averages, just stay away for the meantime, because that means they're not primed to rally too well yet. And then try to look for preparatory patterns like rectangles, ascending triangles, double bottom, divergences. This is what you want to see before you start picking those up, so that at least the waiting time you have when you buy this doesn't have to be too long. You could keep your money in those issues that are stronger and they can generate more income for you in the shorter term. If not, you might really wait, quite a bit of time before these things can move for you. Okay, with regards to sectoral landscape, I wouldn't say there's two exorbitant differences. Right now, property, services, and financials are the stronger ones, then followed by the industrials and holding companies, not so far off from the first three. But clearly, the mining and oil decks are obviously the laggards, so I'm staying clear out of them. So if I would be picking issues, I wrote down the top 5 issues inside each of the 5 indices you have here. The ones that are in color red are the laggards. So if you're going to be picking among some of these issues, the ones that are colored in black should be your first calls, right? And then when you see that some of these others eventually start to improve, if they break above all their key averages, then you can include them into your list. But right now, stick with the stronger ones first. So what I did over here is to also try to line them up for you so that it's not so hard for you to pick. I've managed to categorize what the leaders look like. This table I have is a list of all the index stocks. And you can see from Ayala Corp to San Miguel, these are the list of stronger or the leaders inside our particular market. And this is where you should be picking first from. And then you can keep your eye on the hopefuls. And the reason for this is the hopefuls are some issues that they've rallied, but not yet clearing major resistance, but some of them are building patterns already. So if some of them try to break off from that, then you could now add that into a leader, and then you can go ahead and start to do that. So what I would do is I'd pick majority of my picks on the leaders and maybe have 1 or 2 hopefuls inside just for kickers, because if they break out, they tend to move very fast on the onset. So keep some of these things into your watch. Like for example, Monde, PLDT, they're in major resistance. SM Prime is also there that you might want to keep up. Maybe even AEV and LTG are also look quite good in terms of the preparatory patterns. For laggards, please take your time. Let them convince you that they're finally reversing before they do it. Many of these are still having a very difficult time, so allow them more time to be able to find their feet, so if you would. In this next table, I've included some non-index popular issues that also are relatively traded. And just so you can set that these are more the ones showing stronger trends. Hopefuls, these are ones also trying to break off from resistance. And then, of course, the laggards is the ones that, take your time. No hurry for these ones because they're still encountering some bit of weakness into the market. So I opted to be able to choose 6 stocks for you guys to focus on. These technically are my favorites. Unfortunately, some of them are rallied quite good already. So the strategy here will have to be into pullbacks, and please don't just buy this tomorrow because they're kind of stretched. Some of them are kind of stretched, so you want to buy this on the way down into corrections, okay? So BDO, why do I like it? Basic wedge here, breaking out, and now you're getting quite a forceful movement. So pullbacks closer to 134, 131 is what I want to see for potential entries for BDO. Jollibee has been very strong, and if you notice the rate of ascent it's been doing has been quite sharp. And although that, yes, it has its nice angle, but of course, being a technician, I worry about being overbought in this stretch. But one thing that you have to understand is there's a very big rectangular pattern that's existed since I think 2021 or 2022, and it's broken through that major high, which was 261 pesos. And that calls for something. And I think that's the reason why Jollibee has been very, very strong because of that. Imagine being locked up for a couple of years and now pushing off that boundary. So I think any pullback for Jollibee, especially looking between 257, or if we're luckier, maybe just a little bit more, 243 to 235, these would be opportune moments for you guys to be able to do a buyback in Jollibee. ICTS has been quite a bit of a darling in terms of volumes and movements. They've actually quite keep appearing into the daily strength of the index, quite a lot. And you can see why there was a major breakout here as well, a push up, and then eventually a corrective move like it's doing now. So let's wait for a little bit more corrective elements for ICT and provide us a better entry spot. I'm looking between 235, which it felt quite near today, and then maybe even 227 to 224. If we get lucky, that might give us better entry points for ICT. Meralco is another issue that I've liked. It's been quite sustained in its ability to climb up, but again, it's gone to correction, then correction, then correction, and correction. And again, I think this is something, it might not run away too much, but when it starts to base out maybe with its trend line, or if not the 200-day moving average, I think that'd be more opportunities for us to buy Meralco. That's between 375 to 370, and then 356 to 350 as support. Ayala Land has also been quite a leader. I mean, it was nice to see the big breakout pattern from here, zoom up, and make its correction. So let's just hope that more of a pattern is built here. We want to buy in the lower ends of the pattern, either in this area, maybe in this area, that's about 3150 to 3070, or maybe even 30. That should be better areas for us to expect buy windows for Ayala Land. And finally, I put Mondier as a bit of a technical buy. I mean, I just put it here because I'm quite intrigued about the pattern that's currently forming. This looks like a potential cup and handle situation that's supposed to be a good bullish pattern. Here's the cup. So what it needs to do is generate a consolidation pattern here first. And if it can break over a range of about 895 or 9, that should trigger a much more sharper advance for Monday. It looks like it's being accumulated. It's a little early than what I would normally buy, but just in case that you start putting it to it gradually, and just simply put major stops in the lows that you see here on support, maybe at about something closer to 8 pesos should be good enough protection, just in case that we're wrong and it cracks, then at least we're out with not so much of a loss. But it looks like it's being accumulated, so let's keep an eye on this. I'd be more aggressive in my buys if I can see this breach over 895, which is about the high band where you see it over here. But it's starting to look quite good as well.